How's it going out there? It's January 6th, 2021. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So I hope all of you had a wonderful time over the holidays. You know, I did spend time with family, eating a lot. I was on a big diet in December, so I gained probably about 8 pounds. I lost 4 pounds so far in this week, but trying to get back in shape. But I did have a good time with the family. Hopefully you guys did too. And welcome to the new year, 2021, which starts off with a bang as the Georgia results are in. And welcome to the blue wave, where the Democrats will control all the branches. As of now, it's kind of like still up in the air one of the races, but it's pretty much over. And I have to tell you, the market's not factoring this in. People look at the S&P 500 and say, wow, it's up. It's not that bad. There's massive implications, good and bad. It's not so much where the market's going to crash or it's going to go higher. It's different sectors are going to be, you want proof of that, look at the markets today. And marijuana stocks are up 15 to 17% each. Like Canopy, Tilray, Aurora. Look at infrastructure stocks. We'll talk about that later with Daniel, how an infrastructure bill is likely. It's going to probably be pushed early, maybe in with this new stimulus that's going to be passed through quick, right? Probably $2 trillion and $2,000. I mean, it's going to be a lot quicker, a lot faster. Look at cyclicals and material stocks. I mean, a lot of the cyclicals, material stocks, these names you'll find in Russell 2000. The Russell 2000 today is up almost 3%. 3%, the Russell. I mean, it's like 3x what the S&P 500 is up right now. So you can't say, wow, it's great and everything's okay. There's going to be implications for your portfolio, significant implications. And we're going to cover a whole range of sectors later, things you're going to do, things you need to do to adjust your portfolios, because this was a surprise. And there's a 30% chance of this happening after the November elections. If you're looking at runoffs, they almost never win the Democrats because less people, are voting to the point where you might see, more turnout to Republicans. But Republicans usually win runoffs. Whatever, there's science behind it. You can look at the math in Georgia. I think the last time it happened was 10, 15, 20 years, whatever it was. And then yesterday, those odds were only 40%. And it happened. And it's surprised when almost every sell-side firm published reports on what to do. They publish reports today. As you know, we do video now, as well as if you listen to iTunes. A lot of people like to watch on YouTube where we tape this. But I'm bringing up, reports from, this is one from Bank of America. You're looking at Evercore. All these reports, Wells Fargo, talks about Georgia. The implications. These reports weren't published until yesterday because it came as a surprise. And how did Joshua portfolio? Jeffries, Goldman. I mean, these reports are everywhere. And they were all coming out today. I mean, they weren't published before 3 days ago and said, no, they said, it's a slight chance that this happened. Now it's happened. Now you see the adjustments. And some of these adjustments are pretty massive when you look at them. So when I look at this and how to structure your portfolio, we're going to go through all of that today, which is important. But when I went through and read these reports this morning, they were kind of all over the place, ranging from the 10-year going to 2% next year, the Fed raising rates in 2022, which I don't think is going to happen. And they're saying that 2022 instead of 2023 because everything's getting pushed forward, right? It's more stimulus right away, maybe infrastructure, and less stimulus maybe throughout 2021 and 2022. I think that's horseshit, to be honest with you. But lots of forecasts. Inflation forecasts, inflation going up tremendously. So there are serious implications where you have to adjust your portfolios. Now, I have one sell-side report from Bank of America. And this is interesting. This was published yesterday. Talking about Georgia and Biden's proposals. So they're saying basically, this is yesterday. If Georgia wins, Biden's tax cuts, tax raises, not tax cuts. I can't believe the president actually ran on saying he's going to raise taxes and won the election, which is amazing. You don't usually see that. But, I have this up now. They're saying it's going to take 7% cut in S&P 500 earnings. And most of it's due to taxes, right? High corporate taxes. higher taxes all around. And some say, well, that might not happen to 2022, but they say a 7% hit to S&P 500 earnings. And you might not think that's significant. But if you look at how much earnings grew after we had the tax cuts through Trump, it's significant. It's even more significant because I did a lot of research on this and went back to 2002, all the years annually. And you're looking at the average annual growth in earnings for the S&P 500 is around 7.5%. They're predicting now that's going to get cut by 7%. So much slower growth. Why is that a big deal? Why is that a big deal? And I'm going to give you a great resource here. If you go to Google and just put in FactSet earnings, they come up with a report like every 2 to 3 weeks. 30-page report, absolutely for free. It's amazing. You know, for earnings junkies like me, they have tons of stats, compare it to everything. And you know, when I see this and looking at what they're saying right now, it's kind of amazing because you're looking at a market right now that's trading at a forward PE of 22. And this is above the 10-year average of 15, way above. The 5-year average is 17. So you have the PE ratio here at 22 times forward earnings, which is one of the most expensive valuations we've seen outside of a couple of periods in the past decade, maybe in 2008 where earnings were crazy and people cutting earnings, cutting dividends, and also .com. But one of the most expensive valuations that we've had in decades, in many decades. So 22 times forward earnings, and now we're seeing earnings growth going to slow. And if we look historically, that's usually unsustainable to the point where stocks pull back. I mean, when we see expensive valuations coupled with unexpected slower growth, which you're going to see in corporate earnings, usually we see steep pullbacks in equities. Usually. It's a different time now. If you want a good example, think of a growth stock that you've owned that was growing 40% plus annually, and it's up 100%, 203%, and you know, continues to grow tremendously. And all of a sudden, one quarter they come out and say, well, growth is going to slow a ton. It's going to slow to 5% annually. I mean, the stock falls 30% in a day immediately. You lose that growth premium. You see it happen all the time. I know you guys see it happen all the time. I mean, there's so many different examples. If Tesla says that their deliveries, which are close to 500,000, but if they're growing at 30%, 35% annually, I mean, you know. But if they say it's going to go from 500,000 to next year to 550,000, the stock's going to fall like 30%. And you're talking about a company's growth who you know, 30, 40% growth to now single-digit growth. I look at the value. The reason why they have this insane premium is because they're growing. Yes, the battery company, I know, but not that Ford's a comparison, even though they get into electric cars, but just to show you the difference in what's going on with the market, which is insane. Tesla sold 500 cars last year as a market cap of over $700 billion. Ford sold 545,000 cars last quarter, 3 months, as a $34 billion market cap, and they're getting into electric vehicles. Again, not the most apples to apples comparison. We know Tesla, the technology, the batteries can be used so many different things. I get it, but the valuation discrepancy is crazy, and Tesla, it has that premium because they're growing so fast. So I'm using it as an example. So what does this mean for the markets? In order to sustain these crazy valuations, because now you're seeing slower growth, the Fed's going to have to keep rates at zero forever. Forever. I don't care what people say, well, 2023, they'll probably start raising rates. If inflation gets wildly out of control, 3-4%, maybe, but they're not going to have a 2% inflation target. They're going to change it. They're going to say, it's 3%, 4%. They can't raise rate. We have too much debt. You say, well, they control short-term rates. Long-term, they'll issue yield curve control. And I talked a lot about that in one of the promotions that we did. That if long-term rates start going high, they're going to implement. They have to. How can they afford to pay the debt? It's insane. You're looking at the numbers. I'm going to break them down later of how much we're spending. On a fiscal side, we're going to spend more money in the U.S. than the rest of the countries in the world combined in fiscal. Think about that. And then we have a Fed that not only keeping rates low, it's more and more stimulus coming out. I mean, we have a Fed in our government that believes a 20% correction, it's not allowed to happen anymore. We cannot see that. We cannot see. If it does, we immediately need to do whatever we need to do. If it's back up the banks or whatever, we can't see that, even though it's a normal course of action. Usually we extend on one end and we pull back and forth, right? And you adjust. There's winners or losers. That's the way the market works. Not today. You could buy now and then buy in the day of the news, and you're still going to make money because everything's going high. That's a bull market. Some of you, you think you've been in a bull market the last 10 years, not like in the last, pretty much 5-6 months, where everything goes higher. You're seeing things going 300% higher like nothing. That's like .com era crap. But welcome to that bull market. But it's not a bull market in everything. And we're seeing that. I don't know why technology is down. That's kind of weird. You'll think, Biden and a blue wave is bad for technology. I don't get it. But if you're looking at some of the things I do get, it's low rates for a long time, more stimulus, and the two biggest beneficiaries are going to be Bitcoin and gold. Bitcoin started to 35,000. 35,000 right when you kind of knew that Democrats are going to win. So you're looking at 9 p.m., 10 p.m. around there, and then one county said, we're tired. We're going to go home. I love that. You got one freaking job to count vote. I gotta go home, man. We're gonna count at 8:30 in the morning when we wake up. I mean, that's your job. That's your job. It's your job. Imagine you said that you went to work. You know what? I'm tired. I'm not gonna do my job today. All those deliveries got to go out. I'm just gonna do it tomorrow. It's awesome. It's so awesome. Anyway, the expectations is gonna be busy, and they did a pretty good job counting it right away. I mean, you kind of knew the results last night. They come in this morning, and one of the races will call for Democrat, but the other one's gonna be called for Democrat. But you're looking at interest rates low for a very long time, more stimulus. Yeah, Bitcoin and gold. And this price gold is down a little bit today, but it did run up into this. And you have your solars, your winds, great sectors to own for a blue wave government, along with infrastructure, healthcare. They're going to really push healthcare and more money going into so many different stuff, materials, industrials. While energy is up right now, mostly not because of a Biden win, but, you have to be a little careful there too with energy where, they're really against fracking. So how long can that be sustained? But we had, cuts around, OPEC and Russia and things like that. And, it's pushing oil price to $50. I think it's a function of the blue wave or anything. I think energy is going to get hit. I'd be taking some profits in it. I mean, it's up a ton. And again, not sure why so many market forecasters believe a blue wave is bad news for large cap technology. I mean, these are the ones that funded the Democrats, right? This is factual. Yeah, Google, Twitter suppressed tons of sites, right? Conservative sites, which again is fact. Clear agenda there, which is factual. You can look at all the statistics, all the search results, how, go vote. It's just the things that they put in front of you. Yeah, but I don't know why they think that's bad for big tech. I mean, you think they're going to split them up. They split them up, buy them. They're going to be 10 times bigger. They might not have monopolies in social media and things like that, and Google, who knows? But, if they break them up, you're going to get pieces of all those companies, and you've seen throughout history, when that happens, yeah, you could prevent monopolies and, Rockefeller and things like that, and railroads. But those companies and those people become, they increase their wealth dramatically when that happens, because now they own pieces of all these companies, which is, But anyway, is that going to happen? I don't know. I think tech might be a buy in this pullback, and we'll cover a lot more of this later, but you need to do one thing for me. One thing, which is nearly impossible, but I'm going to ask you to do this. You need to separate your personal feelings about politics from the feelings you have for taking care of your family and providing for them. It's two totally different things. Because if you invest emotionally, which we all do, even professionals do. I'm not just talking about emotionally losing money, but you could invest in Tesla. If you had options on Tesla and Tesla takes off and you sold it too early, there's emotions involved. Oh my God, I only made $5,000. I could have been up $100,000 if I kept it. It's hard to, I don't care if you're a trader, if you look at charts, it's hard. You're always going to look and have those feelings. What if? What if I did this? Could I make more money? What if I did this? I would have said, you're going to invest emotion. People do, okay? But you want to try to keep that in check, because you're going to miss out on making a small fortune. Because it's not too difficult to see what sectors are going to benefit from a blue wave and what industries, what stocks. It's not difficult. But you're talking about, if you invest emotionally, again, which you all do sometimes, you can miss out making big profits, and instead, investing the right way. Just look at it and say, okay, this happened. How am I going to make money off of it? What are the stocks and sectors that are going to benefit? You could do that, or waste your time on social media shouting about how Trump is a bum, he's a crook, he's a racist. He's an ass. You hate him. Well, if you're conservative, shouting about how Biden can't complete a sentence even with a prompter, right? Have fun. Go on social media. Do that if that's what you want to do with your spare time. My job, you listen to me, to create generational wealth, to make more money than you've ever made for your family so your kids have a better life, right? That's why you're listening to this. That's why you should be listening to this. That's how you have to look at this. There's emotions. They're very, very high. I get it. I got caught up a little bit in it a couple months ago. It's very frustrating. But you got to put your emotions aside and invest in the right things accordingly. You could be pissed at the Fed. It's like cheating. You know, hey, we have low interest rate. We have slower growth that's going to happen because of higher taxes. And we have a super expensive market. That's a recipe for a market to fall 25% at least. But it's not going to, because our Fed is providing stimulus and said basically we're going to keep low rates forever. And this stimulus, the next way, now the Democrats, it's going to be huge. It's going to be huge. $2 trillion, maybe over $2 trillion, $2,000 checks, and maybe you throw in infrastructure, maybe it's $3 trillion. They're going to try to get that passed. You might be able to get that passed. We've seen a lot of these stocks take off. And when you look back at 2020, we did a really good job staying ahead of the markets. Just selling out before the crash in March. Getting back in May and April, not at the bottom. Still nervous. I had no idea the Fed would say, here's $6.5 trillion. Get 12 exercise of TARP to save the world. And then, hey, we benefit tremendously. We pounded the table on Bitcoin, on gold, small caps in August, September. I told you, listen, the small caps usually outperform large caps when you have economic recovery, and they're down significantly. And we did fantastic in our portfolios, recommend a lot of those stocks, especially cyclicals. Recommending Goldman 3 months ago when everyone thought, hey, what are you, an idiot? Banks are out of fit. Now, the whole world loves banks, right? Banks are the greatest thing in the world. I think Citigroup was up 5%. But it's nice to see Goldman getting upgraded by sell-side firms when we're already up, 25% plus on it? Because we're getting ahead of things. That's what we want to do. We want to get ahead of the street and stay ahead. We did a good job in 2020, and I think we're going to do a fantastic job in 2021 if you keep your emotions in check, which is hard to do. So by doing that, and if you're able to do it, you'll make money in 2021. Again, it's not going to be that difficult. Just finding out what works. I'm going to give you tons of ideas, I promise you. But it's not that easy when you have social media dictating what you read, what you see, what you don't see. And then whatever media channel you watch, I don't care what side you want, they're all biased. They're not reporting the news to you. It's an agenda. They all have an agenda. We've seen that. They don't even hide it anymore. But you have to come back with what's the most important thing to you. To me, it's my family, it's my kids. That might not be that for you. I don't know. If it's not, if you like just shouting from the top of the roof, you want to be famous, write books, whatever you want to do about politics, that's fine. For me, that's the most important thing. Generational wealth. It's when my family has a better life than I had. At the end of the day, it's about your kids. That generational wealth. And then when you're rich and you make a fortune, you can retire, donate money to any political organization you feel fit, and then go on social media all the time. You got plenty of time when you retire. But get rich first. Otherwise, you're just going to be sheep. While the wolves, our politicians, social media companies, control your every move. If you want that, that's up to you. Take it. It's your decision, though. Or do you want to just leave your emotions behind and make money on something? Listen, we know the sectors are going to go up. We know the stocks are going to go up. We know what's going to happen. They said their agenda, Democrats. They have their agenda. We know what it is. They could do almost anything they want right now. Again, we're going to cover that after our interview, which, by the way, I have a great guest today. If you read our content on Curzio Research, it's a name you're going to be familiar with, and that's Luke Downey. So Luke's a 10-year-plus veteran of the markets. Worked at numerous institutions like Cantor and Jefferies, co-founder of MAPsignals, which is a proprietary system used to track inflows and outflows of the smart money. And Luke's been making money off this system for over a decade. And you could see that if you're reading his articles on our site, which is awesome. And the value that he provided is incredible. And he's also one of the best growth analysts I know because he used that system to find the best growth stocks. And today he's going to share and talk about his methodology for finding tomorrow's big growth stocks or tomorrow's Pelotons, Netflix, Zooms, Teslas. And Tesla and Netflix are two companies that he had years ago, right? He has the track record to prove that. He's going to show you how he does it. He's also going to tell you his favorite growth stock to buy right now, which is very controversial. Has some short reports written on it, but it is hitting new highs, which he likes. And most importantly, we have some pretty cool news to share. News that's going to benefit all of you immensely. No, I'm not hyping it up. You're going to see in a minute. Great stuff. And just one note before we get to that interview is the last time I interviewed Luke, he's been on a podcast several times now. He's in his house and he's got young kids and they're running around and screaming, going crazy. So usually we like having all this on video now. We do it. But for the video portion, we're only doing audio for the interview. But everything else, like you see what I'm talking about right now, and even the charts that I'm bringing up, you can see everything on Curzio YouTube, Curzio Research YouTube page. Be sure to subscribe. Again, you get all this information. It's really cool. You see the sites that we're looking at. We're bringing up, showing you, things that you're not going to see anyplace else and trying to educate you. It's a lot easier because we do our newsletters like that as well. But for Luke, he's like, you know what? My kid's going to run by. It's going to get crazy. And he said, let's just do audio. And I said, audio is fine. But then we're going to come back with day and do a video if you're watching this on YouTube. But if you're not, you have nothing to worry about if you're on iTunes because you just listen to this, which is really, really cool. So I just want to give you the heads up on that quick note. And let's get to my interview with Luke right now. Luke Downey, thanks so much for coming back on Wall Street Unplugged.
Good to hear from you, Frank. Glad to be here.
So we have lots to talk about, including really good news, Curzio Research, and you get to it in a minute, right? And also I want to get to your whole MAPsignals, how you select stocks. But before that, let's talk about the markets, right? We just ended 2020. Pretty crazy year. S&P 500 surged 16%. NASDAQ did a lot better than that. And now, you've been writing for us a long time, and you're saying that you're a little worried because they're showing extreme overbought levels. And I guess my question to you, haven't we been overbought for a while? I mean, a lot of things that I'm looking at, it seems like we've been overbought for a little while. But what are your thoughts on the market now, coming out of 2020 and going into 2021?
Yeah, great question. Great setup. I think if we could rewind a little bit, we look at 2020, something pretty amazing happened in 2020. I did a study and we actually published this on your website on one of my contributions, but nearly 50% of 2020 spent overbought. And that was pretty amazing because that hadn't happened in over 25 years. Now, obviously we know we had a pandemic, so things are, a little bit strange and everything's acting a little bit out of the ordinary. But for half of the year, practically, markets were overbought. And I think everybody's 401ks, brokerage accounts, everything basically was at all-time highs. And then I think we kind of came into this election setting for November. We did a really cool study that said, and this was before the election, that typically, on average, going back to 1990, big money moves out of stocks prior to the election, and then big money moves into stocks in a very big way after the election. So basically, it's like, there's this uncertainty that happens. Maybe these big fund managers, they de-risk a little bit, or at least flatten out. Then once they know who the victor is or who they think the victor is going to be, then they can go and place their chips. And that's exactly what happened, not only from a historical standpoint, but also happened in 2020. And so it didn't take long for us to get overbought again. And so now to your question is, we are extremely overbought. And the way I look at that is it's basically, what is the big money doing? And we have this really cool indicator. It's called the Big Money Index. I think, I live and die by this thing. And it basically just tracks, how many stocks are going up with this big money activity, how many are going down with this big money activity. And whenever we hit these lengthy periods, 4 weeks, 6 weeks, 8 weeks, whatever it is, it tends to be unsustainable if we're overbought, because, markets have to correct. And I find corrections are really good for buying great stocks on a discount. Maybe there were some names that, we may have missed out on in this big rally. And so what we're thinking about right now is we're very extended, very overbought. The data historically says that there's a good chance that we could see a modest pullback maybe at the end of January.
That's interesting. I mean, only because I would think if you're looking at the markets and look at fundamentals, right? And you look at institutional money coming in out, which you're going to talk about through MAPsignals and stuff, which has been fantastic, guys. Luke writes for our site, Curzio Research, and his findings can be there. We have, just so many testimonials about you and positive things that, you've helped people, and, your stock picks, your market, everything's been like dead on so far. And you've been writing for us for a long time. But when I look at this market, looking at it trading at 22 times forward earnings, which is 60% higher than the 10-year average. And you're looking at earnings where you're not seeing the massive growth. You're seeing the rebound in earnings, of course, because they came down so far. But it doesn't even seem like we're going to have the earnings growth there. And it just adds to how important the stimulus is and how important Fed policy is, because that's really driving stocks. And I don't know if that's going to change or not, but maybe that's what I got wrong, because I thought we were kind of overbought, saying, hey, guys, don't come out of the markets. For me, I've learned my lessons. Never sell things that are going higher and higher and higher. You could take some off the table, but don't sell your full positions. But even now, it just feels like with that thesis, I've been wrong. I've been long, but, just took some off the table. But it has that feeling like, is that the right strategy? What's different this time? And I don't know if you feel that way, because there's an underlying current under this market that doesn't make sense from a fundamental or maybe even a technical view, where, we're relying on stimulus and the Fed, and these guys, think a recession, or not a recession, but just your normal pullback or a correction is very, very bad, when this is a normal course of action for the markets going back hundreds of years, over 100 years.
Yeah, no, I think the only thing that I could really compare 2022 was what we saw in 2008. And I had a front row seat and watching just that complete collapse, and watching my customers, a number of them just went under. And then, once the Fed, got involved, it basically was like a reset button as far as I was concerned. That was kind of whenever, Jesus took the wheel, and everything basically rallied, for the next, decade, right? I think a little bit of that happened in 2020, and that's kind of the way that we've been positioned, and the way I've been thinking about things is, the Fed had to step in, and we discussed this in March. It's a great time, to be on your podcast. And there wasn't any announcement yet of what they were going to do and how far the stimulus was going to go, but there was a sense and there was this urgency that they were going to do something, and I thought they were going to do something in a big way. I think whenever they do that, Wall Street knows, at least historically, that that's going to be good for stocks. That's going to be the ballast that we need, that is going to help us bridge the gap of those that earnings drought. And so, you look here, and if we just fast forward past January, even if we get a small pullback, I still think it's going to be a great time to be adding to stocks, because I think the comps that are going to be coming in Q2 and Q3, I think it's going to be easy to beat. And I think that that's what Wall Street, I think that's what their models are really looking at is, are we going to have stacked growth for the next couple of years? And it seems like that is the case. And if we all agree, or if we think Wall Street agrees to that, then, we're going up, up, up over the long term.
No, and I want to get into how you make these forecasts, because, we have been interviewing analysts for over 13 years now, 14 years on this podcast, and everybody has their opinion, but you actually have a certain system, which you write about on our website, Curzio Research, and it's through MAPsignals, where you're following the big money. And I guess my question is, when you're following the big money, I've always prided myself on being contrarian, but if you follow the big money, you could still be contrarian, right? Because sometimes you'll see big money flow into ideas, and you're not really seeing them talked about a lot in the media. Does that factor in? And let's go into, MAPsignals and how you come up with these forecasts, because, if guys, seriously, it's for free. Go to Curzio Research. If you read what Luke's been writing, since he's been writing for us for a while now, you can see how accurate it is. And it's based on this MAPsignal system, which, you on your website, at least 1.2 million pieces of data that you're analyzing on more than 5,000 stocks. So, it's except for penny stocks, but there's a lot of effort that goes into you just coming on this podcast and saying, hey, we think we could see a pullback in January, isn't it?
Yeah, totally. I mean, just this past weekend, I spent hours and hours. My wife was like, what are you doing? And, Frank, me, I love this stuff. This is outside of my family. This is what I think about all the time. And what we're able to do and to make these forecasts is we basically are just measuring all of these thousands of stocks and to see if there's a trend, right? Is that underlying trend that money appears to be going into these stocks, or is it coming out of these stocks? And it doesn't matter if there's a rotations happening, because we can still look by sector, we can still look by ETFs and all of that. And so we use that as our framework. And now that we've been in business for going on 7 years, there's a little bit of muscle memory that kind of comes with this, meaning like, have we seen this before? Right. And so whenever we start to see these thematic plays start to unfold, we're able to circle back to a prior time in history, whether we were in business at that time, and then make a forecast from there. And a couple years ago, we filled in our data all the way back to 1990. So we did a pretty extensive, took a long time to do this back test. And what we're able to do is kind of look back and say, what is similar now that happened in certain periods. And then we can kind of formulate an action plan. And even though that's just the data framework, we also have to use our noggin on top of that. We have to sit here and say, okay, well, what was happening the last time that we saw any type of stimulus that was similar to this? And then also we have the advent of ETFs. Those kind of got started really in a big way in 2005. And that's really kind of been a driving force for us to look at big money. So big money may be hedge funds, maybe pension funds, it could be ETFs. It doesn't matter. It's just, where is the flow of money coming? And, most recently, probably the Robinhood traders have taken over Wall Street. And so that's what really is helping us to make these forecasts. It's all based on data. It's not based on gut. It's not based on feels or anything like that. We don't get it right all the time, but definitely it's a very extensive thought process of which way you want to lean with your portfolio.
Now, when I look at this methodology, it seems like it's focusing on growth stocks. Is that just where the institutional money is going right now? Because we are seeing kind of slow down a little bit, but you saw the airlines bounce back over the past couple of months. A lot of travel-related value plays that have gotten crushed, caught a bid, even energy caught a bid. Those aren't growth stocks. But it seems like you focus on a lot of growth names. Is that because of the system, or is that just something that you do where this has been the way the market's been in 10 years, and it doesn't seem like it's changing, where growth is definitely outpacing and much more favorable than value?
That's a great question. So the main reason is, whenever we look at everything just from a data framework, every stock is looked at individually on its own. Now, what we do and what we learned to do whenever we were trading on institutional trading desk is that there were higher quality names than other names. And so we came up with this really cool ranking process where we would actually score the stock based on not only the big money activity, but also the fundamental health of the company. So, are they growing their sales? Are they growing their revenues? Is there a narrative? Is there better guidance, et cetera? And then also just ranking the technicals of, how the stock is actually trading. So I myself personally have always loved growth stocks. I really wasn't interested in finding a stock that's going to perform in line with the S&P 500. I've always been looking for the next Netflix, and I was lucky enough to get that one. The next Tesla, I was lucky enough to get that one as well. And that's where I think that, I'm trying to be is I'm trying to not only just beat the market, but find these outlier stocks that, history has shown that about 1% of all the stocks make up most of the gains for the stock market going back to, nearly 1920.
And that's a good point. I mean, interesting stat that I saw yesterday, which you may know. I didn't know, but you're looking at the market where it did so well, right? It's up 16%, the S&P 500. If you're looking at the individual names, 40% of them showed negative returns last year. I thought that was extremely high. I don't know, extremely high. I know energy financials are in there. I get it, but I was like, wow, I didn't. You think that all you had to do is throw a dart and everything came back since March, but not necessarily the case when you're looking at individual names.
If you're not in the best of the best, you're not seeing the gains that what we're basically seeing on some of the other outlets that you see, and that's kind of been the whole crux of trying to score and to actually rank names is, if you're going to get into the investment game and you're going to pick single stocks and specific stocks, shouldn't you be glued to the ones that are changing lives and making new all-time highs consistently. And, they're basically having a moat around their business and, changing the way we live our lives. I mean, that's the type of stuff that we're looking for. And I've always, even as I've gotten a little bit older, I'm looking for that high octane, but high quality stock.
So now for the big news. Talking about your methodology so much, and hopefully I love talking about that and learning. So hopefully that comes across to investors. Sometimes you're just like, Luke, just give us a pick, and we'll go over that later on and see, what you like or what you're seeing based on your system. But you talk about growth stocks. I felt like that was a huge need for Curzio Research. I always have people write for our sites first. And look, it's writing, and to me, it's more of a character thing to see, how serious you take it, how much data you're providing, and how you're educating my investors. And some people say, I'm going to write a couple of weeks. This isn't worth it. You've done it for a very long time, to the point where, we look at this, and when we get positive response, we want to do what our customers want us to do, right? As much as we can. We're not going to start some crazy newsletter that only has, in an industry it's not going to work. We're not going to make money off of. So, but we always want to follow what our customers want. And they're looking for growth stocks. They're looking for a way to play this. And we decided to partner with you to start a newsletter. It's going to focus on growth stocks. Very exciting in early stages. If you are a Curzio 1 member, you're going to get beta version starting at the end of January. But, I just wanted to introduce that because I'm really excited to work with you. And that's the first of a newsletter where it's going to be a front at a very low price so people could see your work. But then we're going to come out with something more sophisticated, not too sophisticated, but it's, a back end product where you're actually going to be focusing on options and things like that, right? Why don't you talk about, how you approach the market using MAPsignals, that methodology, and say, hey, you know what, Tesla came up on your list a long time ago. But also, when you really see something that's exciting, you have option strategies around. Is that correct?
Yeah, definitely. And thanks for bringing that up. I'm really excited about the partnership and talking about stocks. This is what I love to do. This is what you love to do. And if this fits a void that Curzio Research can utilize, I'm all for it. So I'm really excited. I think it's going to be really great. And to talk about what we'll hopefully be working towards is number one is isolating just a lot of these growth names that might be on people's radar, may also not be on people's radar. Try to find these companies that are early in their cycle, that are growing in a healthy way. They dominate their space, and in terms of how long we might hold that, it really just depends on how much are we making in terms of return. I'm more of a longer term minded investor. So I kind of have a two-pronged approach. One is, you want to have your outlier stocks, you want to have your great stocks. That's kind of, your core. And then there will be these periods, through data that we can, make a change. If we want to lighten up a little bit, and that would be based on, big money's coming out of stocks. Maybe you do an options trade during there. Whenever markets get oversold, that's a great opportunity where you can limit your downside by using options, same type of stocks, same type of profile, and really just, as markets are extreme and crazy, I think it'll be a balanced approach of not only using data, but all the things that I've learned over a decade plus of being an investor.
Yeah, and with your institutional background and institution, what I love about you, which is rare, Luke, is that even through your writing on our site, is you explain things to average investors, which is important. It gets lost in our business so much. Especially, I came from the sell side as well, but it's important because most people out there are looking. They have their full-time jobs. They're looking for us for ideas and learn about the markets. And you have people talk about EBITDA, enterprise value, moving averages, like we talked
Right.
about institutional inflows, outflows. You explain everything in detail of what that means, why it's different this time than other times. And it's, I mean, the importance of that, I can't overstate. It's just incredible because that gets lost in a lot of people when they're writing and they come to me and say, hey, can I mark? I was like, you got to make it simple because people don't understand what you're writing. They're not going to subscribe to your work. So it's amazing how you put everything in perspective for average investor to understand exactly why you're buying the stock. Everything you write about, you explain, which is really cool. And I'm really excited to launch our first newsletter with you. And that newsletter will probably get launched, I would say, around March, and the back end will come out maybe a month later or so. But we are going to provide beta issues to Curzio One, who, those members give us feedback and say, hey, we like this, we don't like this, and we try to tailor it because, we care about our customers here, and like every business should. So we want to basically tailor it to your needs, and now they're going to get access to a lot of growth stocks that they might not have heard to, and hopefully, some of the ones that get invested in early that become the biggest names where we've seen, man, Tesla, we've seen, people look at fundamental, they can't understand it, but Tesla, Zooms, just the Pelotons and stuff like that, it is pretty crazy, and having access to that, knowing how to invest in that is going to be really cool. I think people are going to get excited.
Yeah, no, I mean, it is boom time right now. And, I've been holding a lot of names over years that I've collected, and just to see the power of, some of these outlier stocks. I mean, just look at Tesla. I think I bought that one back in, I think it was 2000. It was either 2010, 2014. I'm not even exactly sure, but the thrust that stock has had. And I mean, there was half of Wall Street was, shorting it. The other half was saying that it was bullish. I was just looking at, what's the big money say about that one? And obviously that one turned out to be one of my biggest gainers of all time. But that's what we're trying to do is, if you can, spread your risk out a little bit, get some of these. I mean, that's kind of like my cryptocurrency play. I just put a little bit of money in Tesla, and it turned out to be a pretty nice position. I'm not a cryptocurrency guy, but to me, it was the same type of asymmetric risk profile. So yeah.
No, that definitely makes sense. So okay, let's get to the last question here, the most important, which everybody wants to know. So based on your system, what you're seeing, you said you're expecting a pullback in January. Are you seeing anything where more institutional money is flowing into? I know it's EV is seeing social responsible stocks. I mean, you see this bid among different sectors, and even energy is catching a bid now, and financials. But you're seeing large cap technology pull back a little bit. I mean, pretty much underperformed the market over the past couple of months, especially the Amazons and stuff. What are you seeing right now where they're loading up on it, or they're actually easing back? Is there anything you could talk about, or any ideas you could share?
Sure. Well, there's definitely been a big bid into industrial and material stocks. And so that could be, until we get to a reopen phase, they're going to have to turn the machines back on, right? And so I think that that's what's happening with a lot of these industrial names. We're starting to see also banks, coming back from the dead. A lot of those plays have been just beaten down to the ground. I think for most of 2020, they're actually coming back. Inside of that, to talk about big cap tech, yeah, there's a lot of names that have really kind of been stuck in neutral. But there are some of these smaller caps that I think a lot of people have been talking about, the small cap rotation that's happened post the election once the vaccine news was announced. There is a lot of names that are just exploding higher, and these are some of these sub 10 billion market cap weighted companies. That's some of the stuff that we've been looking at. And there's some definite, interesting plays that are in technology, smaller names, not necessarily these big tech names. But that's what we've been seeing as magnets for big money recently.
Now, I won't ask you unless you want to share individual names, but I know you're going to share individual names in your beta versions of the newsletter. But I don't know if you have any individual names. If not, that's okay. I know you're going to share them with subscribers going forward. But yeah, I wanted to see if there's anything that really caught your attention. That again, not that you tell them to buy or right now, but something that, hey, you know what, it is interesting. It's not just materials, but specifically these companies and materials and banks that are seeing inflows or outflows.
Yeah, I think an interesting one that I've been looking at is it's a small cap name. This is definitely going to be on the, it's going to have a higher volatility than some of your other names, and that's Grow Generation. And this one kind of came up on our radar, I want to say maybe a couple of months ago. The ticker is GRWG. It's not for the faint of heart. They basically are based out of Colorado. They deal with soil, nutrients, any type of if you're in, horticulture or anything like that. But I think what's really interesting about this company is not only are they in a really cool space and a growing space, is if you look at some of their earnings and their guidance, they have just been beating and raising consistently, and the shares have been rewarded. And again, I think it's about a $40 stock, and it's gone up tremendously over the past year. But that's one I think that you could keep on your radar.
Yeah, it's amazing because when you say faint of heart and volatility and risky, everybody wants to buy it. If you say safe, it's kind of not too bad. Safe, paid. People are like, all right.
Yeah, no, I mean, listen, it's some of these names that you got to be careful if, God forbid, you short something like that. I mean, you see some of these stocks. I mean, they are just going moonbound. Once people get a hold of them. So it's interesting. It's not really discussed that much. I haven't really heard this name that often, but it's got really strong fundamentals. It's got great technicals, and it's starting to see that big money activity. And so whenever you have that power three, it's something definitely to keep on your radar for sure.
Nah, it's great stuff. Well, Luke, looking forward to working with you, and a lot of people are going to appreciate that newsletter, and you're going to see stocks being bought after they've made nice moves, but they all have earnings growth, sales growth. We have some of these in our portfolio, but just having a newsletter dedicated to this and showing people how to make money on these things, because sometimes you focus on P ratios and things like that. And if you dig, you'd never have an Amazon, you'd never have Microsoft breaking out here, you'd never have the Apples, you'd never have, the Netflixes, because you have to really look at their growth profile. And, as long as these companies continue to grow, it gets rewarded through their stock price. You don't fight it or whatever, but having a newsletter dedicated to that, I know my investors and my followers are going to be very, very excited. So I'm looking forward to working with you over the long term, not just a short term, but launching a couple newsletter with you. So I'm very, very excited, man.
Yeah, I am super excited too. I think it's going to be great. And, we'll be able to spit back and forth on the airwaves and, really just try to make people money. I mean, that's what it's all about. And I really enjoy this. I know you enjoy this. So I think it's going to be a great partnership. So.
No, that sounds great. Listen, hopefully you and your family have a wonderful new year into 2021, and saying goodbye to 2020, which was difficult for so many people. But looking forward to it. Hopefully you enjoy the year. Looking forward to working with you, buddy.
Same to you. Happy New Year.
Happy New Year. Hey guys, great stuff from Luke. So glad to have him part of the Curzio family. Yeah, if you're a Curzio 1 member, you will start seeing beta issues of this newsletter, which we haven't even named yet. We're going to come up with a cool name. That's going to be later this month, focusing on growth stocks, mid cap, large cap, a couple of small ones in there. And then this newsletter is going to be available for everyone at a really, really affordable price. Really affordable price. And it's going to be around March. So that's, a front end newsletter. So, we do that this way. People who could come in, they see what Luke's all about. And then when, we launch a back end newsletter, it's usually more detail, more research, more, just option strategies and stuff like that. Which he's going to have and be a little bit more aggressive. So, but just, really happy with his work. He's just been fantastic. He shows good character. Again, it's not like we pay a lot. Nobody really pays a lot if you're writing for a site, but just to see him and the work he puts in, to me, it's a character thing. I mean, we have someone here, Veronica, who's a publisher. She came in as a part-time employee. She killed it. She wasn't making, a lot of money, but just at the beginning, because she was a consultant, and then she just killed it. She did fantastic to the point where, I wanted her to be publisher, which is, the top position. It's a CEO, obviously. But the publisher, when it comes to a publishing company, is a big deal, But to me, it's about character. It's, a lot of people come in and just expect everything, and I'm great and I'm awesome. I mean, you got to play the game a little bit and show some respect. And, just seeing how not one of his articles on Curzio Research, it was never half-assed. And I could see that from a mile away, and I hate that. It's like, I'm just going to publish something to make a few $100. No. He really cared. He broke things down. And not only that, a lot of the advice that he gave was spot on during one of the most difficult times in the market, because he was writing for us even before the crash. So really happy to have him part of the team. But again, I want to hear from you about that. Questions, comments, feel free to email me at frank@curzioresearch.com. That's frank@curzioresearch.com. Now I'm going to bring in my buddy Daniel, Senior Research Analyst, Daniel Creech. What's going on, man?
Frank Curzio, what's happening? Happy Wednesday. Happy New Year.
Happy New Year.
Happy New World Order. Too soon?
New World Order. It's funny because...
Too soon, I can tell you're fired up today.
Oh, I am fired up. You're going to hear it today. I'm definitely fired up. But, you say, it doesn't matter, Democrat, Republican, whatever. I don't care. I don't care. I'm sick of people getting sensitive. I'm sick of sensitive people. Like, everyone's sensitive. Everyone gets offended. I'm sick of it. I mean, I don't know when the whole world turned into a bunch, and I won't use the P word, but I don't know why that happened or when it happened, but it's just amazing. I mean, everyone's offended by anything, and I'm sick of it. I'm just going to speak my mind, tell the truth, and if you like it, you like it. If not, there's a million other podcasts.
How's that any different than No, I'm kidding.
No, I mean, it is. It is.
No,
but usually I'm a little conscious and not, like, I get it. But
hey, I'm always having fun. I think people ought to talk more about politics and just understand what they disagree on. But hey, but it's exciting because we got a lot to go over with portfolios, and man, sectors are going crazy.
This was a shock. This was not expected because, as I said earlier, every sell-side firm came out and they were saying how, they just came out with reports. Again, this is a 30% chance after the election, after November, and now 40% chance beforehand. But they all came out with reports today saying, okay, adjusting, and this is going to happen. And it's a lot different from what they were saying like just a week ago. But for all of them to publish reports today, this was a surprise.
Yeah, I mean, and it's what a difference. Let's see, we're taping this a couple hours into the market. Futures were down a little bit. NASDAQ was down, close to 2%. The big FANG stocks, the big tech stocks were selling off. They were all down 2%, which I think is a gift because now I think, is the NASDAQ higher right now? It's as we're going in here. Yeah, all the markets are higher. Life is good. Higher. The big question going forward will, you've talked about this extensively. The market is obviously forward-looking. We try to price in the future, et cetera, et cetera. How forward-looking will the market continue to be? Because this rally, you have to take what the market's given you. It's bullish on a lot of things. And Briefing, the site we use just for news and updates and things like that on markets, they had a really interesting chart today on tax cuts, everything from healthcare and all that kind of stuff. And the tax cuts, the repealing of the tax cuts and increase in capital gains is only needed 51 Senate votes, which looks like they're going to have with the tiebreaker and Vice President Harris. Mm-hmm. A lot of the other stimulus and or reforms are going to take 60 votes, according to this. Now, if that's true, and a lot of that is, you can't just do a simple majority. They can always change rules and different things. But I think that's why you see a lot of the certain sectors like infrastructure and healthcare going higher, as well as finances. And I think that's going to be a good roadmap. Just listen to what they're telling you and keep it simple.
I keep it simple from an investment perspective. We're going to cover all the sectors and some stocks, but it's. I have to be honest with you. After this and what happened, I'm scared. I mean, I'm not kidding you. I'm not. Not that I fear. Oh my God, it's going to be crazy. I just people don't understand the changes that are going to happen. And if you live in New York and California, you're seeing them, but now they just got accelerated. You think it's just 60% taxes? You're out of your mind. If you make more than $400,000 in those states, you're gone. Unless you hate money, because you're going to be taxed at more than 70% now. You're going to be it's 60% now, but it's going to be more than 70%. Where are they going to get the money from? Because you're basically telling, it's almost like the people who were successful and worked their ass off are like an enemy. They're like the enemy. And they have been very clear in those two states. They've said, they don't hide it. You saw de Blasio go on TV and said, nope, this is clearly about the distribution of wealth, and that's what we're going to do, which has never worked in any country anywhere in the freaking world in hundreds and hundreds of years. That's what it is right now, the distribution of wealth. So it's taking, it used to be work hard, you could succeed, you could be great, and you can make it in this world. And you could, be very successful in terms of, how much money you make and whatever. Now it's, hey, you could work hard. As soon as you start making money, we're taking that shit away from you. It's like, what is going on? Like, I just feel like, and I get it. It used to be more moderate Republicans, moderate Democrats, but Trump, the hatred for Trump is so bad to see how you needed the left, the far left, the craziness to really beat Trump. And now to dial it back and say, well, we're not going to be that crazy. You're nuts. Because these people are going to come after you. You see how they are. We're talking about, not just climate change or things like that. We're talking about the Green Deal. Basically done by it's so funny, right? 30-something-year-old bartender who was a bartender that became a congresswoman, which shows America capitalism, how that works. And now you're against that where, emissions, no boats, no planes. If you live in Hawaii, good luck. You're stuck. Bye. Wait, I gotta get up the island. No boats, no planes. That's how far left it was, and that's not going to happen. But just to push it even a certain amount, where are we going to restructure all the buildings in major cities to be environmentally friendly now? Are we going to really kill fracking, which made us energy independent? Which I can't overstate the importance of that. being energy independent. I mean, it led to how many wars through the Middle East because they're controlling something that we need, which means they have control over. We don't need that anymore. But now you're going to go back to the way it was and look at all the wars that happened. So some of the changes and some of the things, then also, are you going to really add people to the Supreme Court? Because that's what we heard and they didn't deny it, right? Are you going to make Puerto Rico Washington State so you have more, you could run the Senate forever? Are you going to really, you're changing the fundamental values of what America was built on. I mean, defund the police is still out there. How many people are cutting their budgets where crime rates are going through the roof? I mean, are these things, there's a reason why gun companies, right? You talked about it. Where are gun companies up today?
Strum Ruger and Smith & Wesson were both up about 8% at the start. So I would assume that they're going to hold their gains. And Strum Ruger and companies up about 9%. And, this is going to be a fear play. If everything holds and they have all the votes to do something, the market's going to, whether it happens or not, the market will, in my opinion, and they obviously are, anticipate either further restrictions or outlaws of some sort. A lot of that demand should be pulled forward, given, the risk there and the headline risk. And, these are still well off their highs. Strum Ruger was at 85 before, midsummer. So, there's going to be a lot of room to run on that. The defense and the, kind of back and forth between the political headlines is going to be crazy. Yes, Frank, I know you're fired up about this. So how soon do you think some major legislation will pass?
When you look at the stimulus, is going to pass right away, and I think they might throw the infrastructure in there.
Right.
That's why you've seen infrastructure stocks go crazy right now, and material stocks like Marietta. You saw Vulcan, and one of the ones we have in portfolio, Summit. I mean, These stocks are running up. We were well ahead of this curve, getting into cyclicals early months ago. You guys should be doing very, very well in all of our portfolios, especially crypto. Holy cow. I mean, you saw a Bitcoin surge to 35,000. It's like it's still up there, still like 34 and change, but
yeah, it's incredible.
But you're seeing this because you wouldn't see these major moves unless there's a surprise where I'm hearing, oh, well, the markets are up. You see, everything's okay. It's not the end of the world, but it's, you have to adjust your portfolio into the right sectors, right? I mean, marijuana, you see marijuana stocks where they are?
Yep, it's going through the roof.
And just Canopy, they're up like 15 to 17% each. Yes, there's a lot of sectors and stocks. I know, you were talking about a lot of that stuff, but you are seeing these massive moves. And again, maybe they just accelerated and just, overreactions. But to get back to your question is we're going to probably see $2 trillion stimulus right away. And that led to Goldman Sachs coming out, Jefferies coming out, even Evercore coming out. And again, I read these reports to see what they're saying, right? It's not that I agree with them, but I like hearing all opinions. It just makes you a better analyst. And they believe that that the Fed could raise rates earlier than expected. You've seen the 10-year. You see the jump in the 10-year today?
Yeah.
So the jump in the 10-year is up like 10%. Was it 1.047?
Who was it from the Fed that said 3% inflation would be okay? It wouldn't be a bad thing.
That 2% inflation target. I talked about that earlier, isn't it? I mean, as soon as we're going to get to 2% inflation right away. This is money that's getting directly filtered to people. This isn't, people are surprised, but we understand why we didn't see the inflation on the CPI level, guys. I know we're all paying higher bills, but the only thing that matters is what the Fed looks at. That's how they dictate and determine policies. They look at, especially, interest rates and what they're going to do. They look at the CPI. And based on that, they came up with a target of 2%. Right? But they're going to change that. Just, they change everything. So they're going to say, oh, no, 2% is okay, 3%. But this isn't back in 2008 when the money was filtered to the banks to stabilize the system, and then they decided what to do with it. This is going directly into consumers. These are checks that are bypassing you working, going directly to you, and it's supposed to be 600. They're probably going to be 2,000. I think it's going to be over $2 trillion altogether. But it's going to be interesting to see because I think that's going to happen right away. But when it comes to taxes and tax increases, probably going to happen early 2022. But the market's forward looking. It's going to be interesting how companies adjust because that's going to result in slower earnings growth, and it's going to take a premium away from a lot of these companies that are trading at the highest valuations they've ever traded in history.
I think you're right on the first legislation, and they've front run that. I mean, they were saying, "Hey, elect us, we'll give you another stimulus," which is popular. I completely understand that. The interesting thing to me is that on Monday, the market sells off in what anticipation to be, maybe a blue wave, which is completely reversed today. But gold popped, and now gold is a gift too because it's down 2.5% today. So maybe all that money is allocated towards Bitcoin and cryptocurrencies. If that's the case and you've had your eye on any gold stocks that are pulling back on today's news, I would look at that, because gold and Bitcoin can both go higher. Yes, Bitcoin is well ahead of leading the race on a percentage turn and everything else, but take what the market gives you, and gold coming down like this when the market is rallying in anticipation of more money is just that's where markets don't meet reality, and you can take advantage of those.
Yeah, it is amazing to see, because eventually, like, so many people think that money's going to come out of gold. JP Morgan said that. I think it was Jeffrey said that, or published a report and said, the money that's going to go into gold is, a lot of that's going to be into Bitcoin. But at what price? Bitcoin's up tremendously. If it goes, I mean, for just to put in perspective, when JP Morgan comes out and says, has 140,000 plus target price on Bitcoin now, not to mention Jamie Dimon said it was a fraud, right? It's a fraud. If anyone trades it, I gotta fire them. 140,000. It just makes me laugh, some of this shit. But it's just so much drama. And I like Jamie Dimon, but I just thought that was funny. Just, clear overreaction to something you don't understand. He's one of the greatest bankers and smartest people that you'll know. But when you don't know about something, you don't know about something. So I love when people talk about being smart. You're smart in certain areas, but not smart in other areas. And, obviously he wasn't smart there. But having that target, when you look at stocks, these guys don't have targets like that are, 3x, 4x, 5x higher. They don't say the stocks will go from 10 and when our target's 75, 80. They say it's 10, our target's 16. When it hits 16, they go,
Tesla.
It's 18. It's 20.
That's the only time you do that, Tesla.
I mean, they've been behind the curve every single time.
Who raised it from 500 to like 800 today, finally?
Yes, and that's the highest, right? The highest target is 10% higher than the stock price, right? Again, it's ran up tremendously. But to
your point, I'm sorry, you're right. I mean, people don't just say that on the
So you would think that JP Morgan is going to, for their clients, if they really believe that target price over the long term, and you're hearing all the 100,000 plus target prices, maybe it is a buy here, but at 40,000, 50,000, maybe at 35,000. I mean, when do you say, okay, gold's not even 2,000, and there's a fundamental reason to be buying gold? So, I mean, not just, infrastructure related, like copper looks fantastic right now. And then silver has industrial use as well. But, when you look at gold and the underproduction, because these guys were so leveraged in 2011, 12, 13, 14, a lot of these guys almost went out of business, the big companies. Now that they need gold, they didn't invest in a lot of these projects. And you're looking at their margins are like software company margins where they're producing for $900 an ounce or $2,000 an ounce. These guys are printing money, and they also produce the majors, hundreds of millions pounds of copper, which is up tremendously over the past, few months? I mean, a ton, up well over $1. That's a lot of money. That's 100 million, 200 million, 300 million right to the bottom line. So when I see these stocks and pulling back, I just think, these guys have to purchase. They have to continue to produce gold in order to do that. They have to find these big projects, and that puts juniors into play. So I love gold here. You could own them both. I know. Just amazing, right, Daniel? How people hate.
Yep.
They hate each other, right? Bitcoin, and I'm in the middle of that because I'm from Wall Street background, and now we have a security token, and just talking to both sides is very difficult because you need both of them in order for this to scale and go crazy. That's why Bitcoin is so huge right now. It's not huge because everyone's finding out about it. It's not huge even because PayPal is Square. No, it's huge because institutions are investing in it. Wall Street.
Yeah, absolutely.
That's where the billions and trillions of dollars are. So you need to get along with these people and need to come up with a solution where all this works, and that's happened in security tokens. But when I see this whole market and just the forecast on this thing, it's going to be interesting to see what price do people say, okay, I'm not buying Bitcoin at 40,000 when it was 12,000 3 months ago. And then maybe that goes into gold. I don't know. What do you think?
Yeah, I mean, like I said, I think they can both go higher. Bitcoin is obviously, well ahead of the game, and it's got momentum now. But yeah, for what you just said about gold and the economic use and everything, yeah, I mean, those things trade like damn near tech stocks on margins and things, and it's still kind of flying under the radar. So I would take advantage. If I can switch gears real quick with the Green New Deal and everything, isn't it awesome how oil's rallying? I mean, that's got to surprise some people.
It is surprising, but I don't know if that's because of what's going on today, with Georgia more than, because it started rallying yesterday too.
Yep, absolutely. Like that. But still leading up to, you got at least 2 out of the 3 until yesterday's election being Democratic tilted. But yeah, I mean, Saudi cut production, so I understand what OPEC Plus and them guys are doing, but you still have economic lockdown. So UK's going down, under lockdown again. They currently are. Cruises are still not going. So it's just, hey, the market's forward looking, and the rally in oil stocks, we've talked about this the past couple of weeks, they are still well off, not even their highs. So, I mean, we're definitely going to have to be digging into that more in the coming weeks. But As crazy as it sounds, because I am, it's no shock to our listeners, I'm as conservative as it gets for the most part. But I can't tell you that I'm bullish on damn near everything right now for the short term. And so take caution on that.
Who would know? You guys see the emails coming in too for Daniel. It's so funny. Gotta get that guy off the podcast, right? He's taking you down. This is people, it's just so funny. But listen, if you don't have everyone hating you, that means you're probably fake. So you should have people like.
Oh, there you go.
I know it's true. It's definitely true. If everyone likes you, that means you're basically pretending to be someone that you're not. Because, again, personalities could be bold, could be shy, whatever. You're not going to get along with everybody, but it's not the worst thing in the world. But I just laughed at you.
Yeah, but when it comes to making money, you got to try to, you got to put that aside and say, hey, like we always joke, here's the environment, here's the rules. Let's play by them. Let's find the roadmap. I love Chuck Schumer, who summed it up best on his Twitter. He just tweeted "buckle up" a couple hours ago. So, you can choose to ignore, or you can look at, hey, what do these guys want to do, and let's put the odds in our favor, and let's make some money, and like I said, let's push chips over and see where they fall.
Yeah, and I'm going to read something too, which I thought is interesting, just to put numbers in perspective, guys. And Goldman Sachs does a good job of this, right? I mean, I know that the enemy, I said it all the time, everybody hates Goldman Sachs, but everybody wants to work for them, right? Because I don't, but a lot of people want to work for them because you're going to make a lot of money if you work for them. But anyway, they talk about, just to underscore the point here, the U.S. just passed a $900 billion fiscal package. And they say to put these numbers into context, that alone is equivalent to 4.1% of U.S. GDP. If you pile on an additional $600 billion, which is expected right away, that's another 2.7% of U.S. GDP. So in English, what you're looking at here is an additional fiscal boost equivalent to nearly 7% of U.S. GDP, on top of the $2.5 trillion that came earlier in 2020. So, when you really put things in perspective like that, fundamentals don't matter. It doesn't matter what you do as a business. There's free money coming into the system. It's not going to stop. How do you benefit? The cyclicals have been crushed. That economy is going to come back. It's not just the Moderna vaccine, right? Again, we're hearing so much crap about the vaccines. I feel like there's an agenda for everyone to just trash the vaccines, right? I mean, for the majority, they have 40,000 people. Again, I'm not telling you have to take it, but if you're 70, my mom doesn't want to take it, but I told her, maybe you should take it because if you get COVID, it's not going to be good with, having that many underlying conditions. And she was, sick a lot. But you have to remember, J&J is coming out, right? AstraZeneca is coming out with different ways. It's not protein-based and, mRNA. I studied this a ton. But these are going to be, a different way of attacking the virus. Those are going to come out. Now you have all of these vaccines at the same time, say 6 months, 9 months, whatever that takes, even by the year end. And I see travel, I think casinos. I mean, these things are going to go through the roof. People are dying to get out, right?
Oh, yeah, absolutely. That'll be the big turning point. Once, I don't know when that is exactly, but, different research reports are talking about mid this year, when's a lot of vaccines going to be out there to where people are starting to say, hey, I either know somebody that got it personally, I'm in line, or I know a handful of people. That'll be interesting to me because once that happens, then it's show me time. Because you can still look forward and say, okay, well, there's still going to be plenty of stimulus. There's still going to be a lot of easy banking regulations, et cetera, et cetera. But you'll know a lot more then about people's mindsets on when more and more people get this thing, what's the data coming in? And you want to look at investor sentiment and you want to look at travel for sure, because that, until then, like I said, I'm nervous to say that, not that it's easy sailing, but I don't know how the melt-up doesn't continue until you get some sort of fundamental change when you're trying to price that in forward-looking. So midsummer, that's when you can really start. I mean, it'll obviously kick in before that as far as sentiment goes, but that's the big turning point for me personally of what I'm looking at. How are they going to react to that once that news is kind of in the mix? I wouldn't say it's priced in yet, but it will be shortly.
No, I agree. It's but there is going to be that inflationary reopen trade, the cyclicals. I mean, I'm pulling this up right now. We're doing this in mid-afternoon. Can we publish all this and get it out today in a few hours after the close? So just to put things in perspective, the Nasdaq's up 0.4%. You know what the Russell's up right now? 3.5%.
Nice.
Holy
CBO,
cow.
there you go.
And you're looking at the Dow up 1.6, S&P up 1.2, but the Russell up 3.5%. Oil is now flat, under 50. Gold down 1%, silver down 1%. The 10-year bond up 10%, which is, over 1% again. So you're looking at Bitcoin at pretty close to 35,000, held those gains, surged right pretty much last night. I was watching. It went from like 32 to 35. And it's funny because I had my script written already saying that the Democrats are going to win because, that's how I felt. I just felt like they were definitely going to win. And saying that Bitcoin was one of the best things that you should own. And this is before the 3,000 move. I mean, we've been in it for a very long time, but you're just seeing it adding to that. But, the fact that gold's interesting. I mean, the fact that it's coming down a little bit, that's fine. But almost every report and everyone, due to the amount of money that we're going to spend, Daniel, and maybe we'll end on this thing, is I said it earlier that we're going to spend more money fiscally than every other country combined, right? So the whole world is shorting the dollar. I think the dollar's going to go low. If the dollar goes low, gold's going to surge. And that's been a trend for a very long time. I think it's going to continue. You could take time periods where it didn't work, but for the most part, if you really want to see a surge in gold, you're going to have to see a weaker dollar. That's usually what happens. That's projected to happen. It's going to result in even investing in internationally in certain countries. I think they're going to provide much better value than the U.S. And upside potential. But it's kind of amazing just to see all this restructuring off of something that happened a few hours ago. And again, this wasn't priced in. You could say, well, the market's up, but it has nothing to do with the full S&P. You can see the NASDAQ, how it's hurting technology companies, which, by the way, Daniel, why is this hurting technology companies for?
I'll be
Blue wave?
I'm the ignorant guy in the room. I have no idea why. I won't get into it too much, but CNBC did some really good articles at the beginning of November of this year. And you can call me, this is how simple I'll keep it. Look at the FANG stocks, okay? I don't know how you would go into fearing them going down when you look at their political contributions by company.
Which is public, yeah.
Exactly. And I don't care who you donate to, but my point is that when you have an overwhelmingly majority, and you could argue, did Twitter, Apple, Facebook, if you want to argue censorship, who do they censor more, one or the other? It's not a secret. It's a political party versus another. So to think that now the party that they donate to and are okay with, are fans of, is in power, why, I think that's a gift. So we'll track those to have fun. Maybe they even get maybe it'll be another Amazon where we sneak it in CRA and be like, we know nobody's going to buy this, and now it's a huge winner. Yeah. So
it's just amazing because Trump was saying how, kind of saying these companies need to be broken up and they have too much power and all this.
Yeah.
But yet everyone said that these companies would benefit if Trump gets reelected.
Yeah.
It's just like, wait a minute. To me, that makes no sense. And it still makes no sense.
And hats off to them. I mean, valuations are high, but they're amazing businesses. Yeah, I mean, the money they generate, the products that they serve. I mean, you could argue Apple's politics, but most people have an iPhone. So, or not maybe most, but I mean, I do. It's not like I go, hell with you. I'm going to go to Google or somebody else's phone. I mean, and if people vote with their feet and their money, more power to them. But they're great companies. So, as crazy as everything's going, I just find I have a good piece about keeping things simple, and I think there's going to be a lot of upside in some wild sectors. But I'm going to have to break down and buy solar, Frank. So be prepared for that in the coming weeks.
Yeah, I know how much you like alternative energy and wind and so. But a lot of these stocks have run up tremendously. But you saw some downgrades, which are interesting. At first, solar, it was Goldman that downgraded them. But these companies are up tremendously, and I just love when people downgrade due to valuation in this market because valuations don't matter.
Yeah,
right. You're hearing that from a fundamental analyst who grew up in a household that was all fundamental analysis, right? And I worked for Kramer and learned with growth and so many different styles you'll see me use in my videos of how we choose and pick stocks. And we have we're doing pretty good job staying ahead of the markets past few years. But just
and to investors, don't panic. I mean, I know a lot of people are upset. I know, but don't panic. The world has changed, literally. I mean, this will be interesting going forward. But it's usually never the good idea to do the easy thing, and panic's always the easy thing. So
it is. And one of the things that I said, like I mentioned, California and New York, just, coming from New York, it hurts to see what the state of New York and what it is now. I mean, how dangerous it is, how a lot of my friends have moved out, how it's just, it's the greatest place on earth. I was jealous, and I used to complain about Florida and say that things are different here. It was, it's a culture shock from coming from New York, fast paced into Florida. I used to joke around a lot about it. But when you're looking at the mayor going on saying that, not hiding it, like the distribution, this is about distribution of wealth. We're going to take money from people who make money and give it to people who probably don't work as hard as you. That's never worked ever. You're looking at taxes right now before you even saw Georgia, and we're talking about 60% across the board for over 6%. Over 60%. Think about that, paying over 6% taxes. Like, imagine giving away over 60% of the money that you earned. I mean, how crazy is that? You know, and that's Georgia, and I mean, not Georgia, that's New York, California. So what's happening is, you know, it's a mass exodus that you're seeing. You could see, I think California's the first year, I don't want to say ever, but in a very, very, very long time where you're seeing, you know, that population go lower. And like, just there's so many people leaving right now. And where they going? I would buy real estate in Texas and Florida. I mean, they're all flocking here. It's seriously. I mean, the price on my house, it's probably up about 60% in 2 years. And, you know, rightly, they're building like crazy, and we live in like, you know, kind of like, you know, on Amelia Island. It's not necessarily like an island, but by itself. But, you know, it's limited supply, but now they're trying to build everywhere they possibly can. And, you know, it makes sense based on the tax structure. And, you know, I get it, but I just don't understand, like, you know, the New York roots and even California and you know, the things that are happening there. It's sad. I mean, these are two of the greatest places on earth, well, used to be. And now, you know, you're looking at crime rates through the roof. You're looking at higher taxes. You know, you're punishing people for working harder and giving money to people that, to me, you know, don't deserve it. They don't deserve it. Some people do. Maybe, you know, if you're handicapped or you can't work, it's different. But just to gradually take money from someone else and give it to another person, I mean, that's never, ever just Frank, CurzioResearch.com, send me an example. Because it's never worked. Don't even bother looking. It's never worked. It's never worked. I'll save you time. It's never worked in the history of Earth. That has never worked. That has never worked. And yet, this is what they're doing. And just sitting by and allowing this and having, you know, I talked about this earlier, and this is why I was fired up, where I'm seeing people in big institutions, in schools, teaching our kids how capitalism, if you believe in capitalism, then you're a racist. You know, that's an effing joke to me. Okay, because you're telling a kid, don't work hard because it doesn't matter, and it does matter. And from someone who believes in capitalism, believes and wants to help the younger generation, you know, work hard and achieve your goals. You know, starting an online class, which I'm going to do this year, the first quarter, where, you know, I'm going to select about 15, 20, you know, younger investors and help them out for free. You know, to tell them, hey, you know what? You're a racist if you believe in capitalism. Come on, man. What the hell is going on? I mean, when do we become like a third world country? I mean, this is crazy. How is it? I mean, it's not even being hidden, though. That's what's funny. It's not even like, all right, these guys have an agenda. And no. How do you come out and say the distribution of wealth? It's kind of, I don't know. I mean, you're smiling, you're laughing over there.
I know, man. You gotta. This shouldn't be that big of a shock. They've told you who they are for a long time. I know I know your perspective is different because it's your hometown in New York and all that. But hey, I will take your advice. If you don't kick me off due to email demand, then I'll look to buy a house here. I'll take your advice. I'll buy a house down here.
You should buy it quick, man. You're gonna see prices here explode. They're gonna explode higher. I mean, there's just so many people that are going to move just for the simple tax structure and make this like their hub. I mean, you talk about people who are very wealthy, where they have, like, you know, 3, 4, 5 different houses. Well, you know, they have the primary residence, but they're going to have a primary residence in Florida or Texas. And yeah, you're seeing that right now. You're seeing very wealthy people, you know, move there, and you're going to just,
we need the whole South to go state income tax free. That way we have choices.
Yeah, no, absolutely.
That way I can get Frank and the crew to go to Arizona.
So, yeah. And the last thing here too, I know you noticed that, you know, we talked a little bit about with gun stocks going up, kind of, I guess it's not really a surprise. I mean, you know, hopefully we don't have it to fund the police. I mean, yeah, there's a few bad apples. I have so many friends that are police. They can't even do their job. They're afraid to arrest somebody now because if you resist arrest, it's the best thing to do, right? You get rewarded for resisting arrest right now. You get rewarded. If you try to take a cop's gun, you get rewarded for that. You get rewarded. If you try to take and the cop shoot you, you're a millionaire. You know, it's like, where are we living? Where are we living? You know, and you've seen those crime rates, it's crazy, man. It really is crazy. But, you know, to see gun stocks go up is a clear indication. I think people are worried, right?
Oh, yeah, absolutely. Like I said, you'll have some headline risk depending on votes coming forward. But, yeah, there's going to be a lot of momentum still in the market with all the fiscal stimulus and everything else. So, yeah, like I said, buckle up. That's the best way to sum it up. It'll be fun.
Yeah. All right, Dan. Well, thanks so much for joining us. Good stuff. And, guys, remember, you know, I mean, look, have a great New Year. I promise I'm going to be here for you, helping you as much as I can to make smart investment decisions. Also providing you lots of cool ideas and staying ahead of the market. Again, we talked about things that we're emotional about a little bit, but at the end of the day, you want to be investing in the right sectors, the right stocks, and it's not that difficult to see if you check your emotions at the door. So you're going to hear us talk about this theme a lot. Not just a podcast. Okay, a lot of you guys podcast, but we have a big percentage too that are subscribers to our products, and you can see the performance for yourself of how we've been doing pretty good. We could always do better, but to stay ahead, keep your emotions in check, even things that you agree with or disagree with or whatever, and just invest in quarterly, because there are sectors that are going to absolutely take off because of the blue wave. And there's certain sectors that aren't going to do as good because of the blue wave. And just position yourself smartly. Don't look at it as the S&P 500 as a whole. Just look at, you see the difference in sectors. We just went across a whole range of sectors, Daniel and I. You're seeing like the Russell would be up over 3% while the NASDAQ's up 0.5%. You're seeing massive shifts. This was a surprise. And how do we adjust? And when do all these things and their agenda, take place? And if you get in ahead of that, you're going to make money in the market. I promise that we'll try to do that for you going forward. So thanks so much for listening. As always, I'll see you guys in 7 days. Take care.